All right, Linda, I will continue to let people in from the waiting room, but we pretty much have everyone at this point.
All right. Well, thank you, Valerie, and welcome everyone to an incredible webinar that we've been excited about for weeks with Doug Duncan, the chief economist from Fannie Mae. So today we're going to, Doug is going to cover many areas about the economy and specifically probably some in Florida because he is a Floridian himself. I hope you didn't mind me saying that, Doug. So just a couple housekeeping items for you. We have the chat box. Doug is going to speak here for about 40 to 45 minutes and we will have ample time for some Q&A. So please type those in and we will address those at the end. If you're attending today, we also are recording this and we'll have the PowerPoint presentation as well, and we will get that to you. So I have the honor of introducing Doug Duncan. Doug Duncan is Senior Vice President and Chief Economist at Fannie Mae, where he's responsible for forecasts and analysis of the economy and the housing and mortgage markets. Duncan has also oversees strategic research regarding the potential impact of external factors on the housing industry. He leads the House Price Forecast Working Group, reporting to the Finance Committee. He's named one of the Bloomberg Businessweek's 50 most powerful people in real estate. Duncan is Fannie Mae's source for information and analysis on demographics and the external business and economic environment, the implications of changes in economic activity on the company's strategy, and execution, and for forwarding overall housing, economic, and mortgage market activity, which we will hear today. Duncan received his PhD in agricultural economics from Texas A&M. Just learned that he's a fellow Aggie. My sister will be thrilled, so we are glad to have you here. And also an MS in agricultural economics from North Dakota State University. So please have me welcome Doug Duncan. Doug, take it away.
Thanks very much. Thanks for the invitation. And I am indeed a Floridian. I grew up in Minnesota, but I noticed that you never shovel snow in Florida. And I had enough snow shoveling to get down to the barn and feed the cows in January in Minnesota that I've banished that as a possibility. So happy to be with you as a fellow Floridian. The title that you see in front of you is "The Economy Speeds Up and Housing Downshifts" is our theme for 2021. There's a disclaimer in front of that, which basically says that the opinions are, that basically says Fannie Mae will deny that I was ever here. But it's basically the forecast is my view of the world and the standard components of a disclaimer. Theme for the year, another way we could have said that was 2020 was the year of the virus and 2021 is the year of the vaccine. Because last year the question was, how will the virus impact people from a physical perspective? What will be its duration, its mortality? How will it affect businesses? How will it affect the views of policymakers? And how broadly will it impact economic activity? Then this year, the question is really about the vaccines. At the beginning of the year, will the vaccines, how many vaccines, one or more vaccines, be available? Will they get distributed? Will they be effective? And will they be resilient to other strains? And then how will individuals respond to that, and businesses observe and respond to what people do, and policymakers respond to what they see the risks are? So really 2020, the year of the virus, 2021, the year of the vaccine. And our view was at the start of this year that the economy would pick up speed, but that housing would ultimately downshift. That does not mean decline.
Doug, you are muted. Can you unmute yourself?
Okay, can you hear me now?
Yes.
Okay, sorry about that.
We're all good.
right.
Thank you. That's okay.
Okay. Sorry about that. And I'm still glad to be with you. And I'm still glad to be a Floridian and not shoveling snow in Minnesota where I grew up. So I'll skip some of the other comments. This title you see in front of you, The Economy Speeds Up and Housing Downshifts, is our theme for 2021. Coming out of the year of the virus, which was 2020, 2021 is really the year of the vaccine. And we had to make some decisions about how the presence, distribution, learned effectiveness, and resilience of that vaccine would affect people and their concerns, businesses, and policymakers. And those were the things that we think were going to be the drivers of 2021. And I think so far in the year has borne out. The part of the problem in forecasting in this space is that the virus is not an economic variable, it's a medical variable. And we really don't have any modern data that suggests what kind of clues we could take about the impact of that virus on economic activity. So in many ways, we're the same as anyone else, listening to the medical community and taking their view on how things might develop. And then we have to apply judgment to our model results in the forecast space and hope that we have picked up on the right things. If you want to go to the next slide. So there was some initial critical commentary when the vaccines first were made available to the public and started to be distributed. I personally felt that was somewhat unfair because while the issue was addressed at the national level, the delivery of the vaccines had to be done at the very micro local level. And we had no mechanism in place to do this. We hadn't done this for 100 years. And so there was no existing network. So it was not a surprise to us that it took some time to ramp up, learn how to become efficient at the distribution, and set up a network of accountability so that we could track things and understand the performance. So personally, I felt it's gone pretty well, given that there was no historic background. So at the moment, there's, as you see by the subhead here, about 45% of those 18 and over have been vaccinated, and about 72% of those over 65 have been fully vaccinated. I'm not going to tell you which of those classes I'm in, but I have been fully vaccinated as of about 2 weeks ago. And you can see geographically that there are some slight differences from a location to location about of the level of distribution of this vaccine. But it's pretty clear, and our bet was that by the June-July time period, that there would have been a broad-based distribution, broad-based enough so that the public would be pretty confident coming out, and that we would see a significant pickup in economic activity. Actually, as it has turned out, that actually wasn't optimistic enough. It looks like the second quarter will, when you annualize the growth rate of the economy in the second quarter, it'll be around 10%. For the full year, we think around 7% economic growth, which will be the fastest growth since 1983. Next slide. So this was a downturn that was historic in its speed, but it was heavily concentrated in what were discretionary consumption categories for upper middle and upper income households. So that includes theaters and restaurants and airplanes and hotels and sporting events. Those are all discretionary spending. They're not basic human needs. So if there's a threat from congregating in dense crowds, then those are all things which would be at risk. And so the consumption of those things basically went close to zero. In that workspace, in that space of services, the workers tend to be hourly wage workers and not salaried workers. Management in many of those are maybe salaried workers, but hourly wage workers predominate. So for example, the homeownership rate in that employment category is only about 40%. Part of it's because they're young. So lots of people bussing tables in restaurants might be college students or young people starting out working. And so they really wouldn't be in a category that would have been buying a home anyway. But in many other places, it's the service sector, like hotel staff and things like that, which are typically salary or not salaried worker, but hourly wage workers. So what you see is, excuse me, is on the right-hand side here that durable goods, that is things like automobiles and appliances, things which last for a significant period of time, have picked up since the middle of 2020 quite strongly. The non-durable goods, that is things that you do have to replace within 1 or 2 years, but which are not services, but they're actually products. You might think of things like things you would buy at Target or Walmart or places like that. I have to mention Walmart because my sister's an executive at Target. And what you do see, though, is in that category of discretionary spending, the services, that has yet to recover. That's where most of those hourly wage workers are. Next slide. So this is a chart that shows at 0 on the left-hand side of this chart, that's indexed to the peak of employment when any individual recession starts. So when the line goes down, that's the job loss that's occurring in the recession. And then when it starts to go back up, it's recovery of employment. And when it gets back up to 0, you've returned to the same level of employment that you had when that particular recession started. So a couple things to observe here. The pink line is the pandemic. It's unprecedented in the speed at which it impacted. So we had a 15% drop off in employment in a couple of months. It was stunning. Nothing else like it, unprecedented in lots and lots of ways. There was then a pretty quick rebound partially. Then the progress slowed, and it remains to be seen how that this recovery will react relative to the last 4 recoveries, which if you have time to study this chart, you'll see the last 4 expansions took longer and longer to get back to pre-recession employment level. In fact, the most recent one, the recession from 2007 to 2009, the expansion following that was the longest economic expansion, but also the weakest that we have had post-World War II. So there's still some questions to be answered about how this recovery will go from an employment perspective. Next slide. So you see over on the right-hand side, leisure and hospitality, still 17% below in April, 17% below where it was in January of 2020. You also see education as 9% below. So the fact that schools are not going back to the classroom has impacted employment in that space. Some are starting now to go back to the classroom. But that leisure and hospitality, that discretionary spending, it has yet to fully revive and bring back full employment. Now, there is one other issue at work here. That issue is that in the most recent employment report, the number of jobs added across the country was estimated at 266,000. The economics field was expecting more like 1 million. So it was a very disappointing, jobs report. But if you walk around lots of communities, you will see there are lots of businesses advertising for work, but many of those workers who would have been working there are actually receiving more compensation on public assistance than they would be if they went back to work. So the level of public assistance has actually exceeded their willingness to work. And some states, some governors, I think currently there's about 13 states where they've reinstituted the requirement to search for a job, which was weakened in the stimulus package, because the businesses are having a hard time finding workers because of that imbalance between public assistance and what businesses can afford to pay and remain profitable. So you'll probably see additional commentary about that in the next months. Some of those stimulus benefits start to expire in the September time period, so we would expect to see some acceleration of employment along that time period. Next slide. So this is exactly what I was talking about, the share of firms with positions not able to fill. You can see that's substantially higher than the share who are planning to raise compensation. The reason for that is you can only raise compensation so far and be profitable. And so it's not as though they aren't willing to pay workers, but if you return to the same wage rates as made them profitable pre-recession, they simply can't encourage those people off of the public assistance back to their jobs. You've seen a couple of firms that are saying they're going to raise the hourly wage. And of course, that will feed into some of the discussion we'll have about inflation. Next slide. So there has been the level of fiscal stimulus that has been supplied in this post-COVID period puts the fiscal deficit, fiscal expenditures at the level that they were in World War II. So lots of these transfers to households are sitting in their checking accounts. So you can see this is on the left-hand side, the savings and checking accounts, pretty stable measure even across recessions. That's pretty stable, but it has dramatically departed since the onset of the COVID and all the transfers that have been made through the fiscal stimulus, the 3 or 4 elements of fiscal stimulus that have been enacted. On the right-hand side, you can see in the March change in consumption, the purchase consumption expenditures by households. You can see in the durable goods category, they were buying vehicles, recreational vehicles, as well as standard automobiles. There was a pickup in clothing, but you have yet to see the recovery of transportation services. That would be the airlines, recreational services, that would be some of the travel components. And you've started to see people, you still have not seen the full recovery of people at restaurants, although that has been picking up. Next slide. So just to give you a feel for where Florida is on that restaurant business versus the United States, it's been remarked in the national press and certainly acknowledged in Florida that Florida has been out a lot sooner than the nation on average in moving toward restoring normal behaviors. In this case, being characterized here by the open table change in seated diners, comparing Florida to the US. So you can see that Florida is actually back to where they were in March of 2020, and the US is still 20% below that. So you probably see that as you're moving around your community in Florida. Certainly we see that in Cape Coral. In the airlines, looking at the TSA traveler throughput, you can see there's still about 30% decline in traffic compared to a year, the same day in 2019. So still quite a ways to go with the airline industry. Next slide. So here that we're looking at the willingness to invest in plant and equipment, capital expenditures by large firms versus small firms. And what you see is a pretty substantial pickup, not yet back to peak in 2018, but a pretty substantial pickup among the large firms. But as you can see, within the small firms, they're still significantly lower than they were at the peak in terms of their investment. Well, part of the reason they wouldn't invest is they can't get workers to deliver what it is that they would be investing in. So there is the tie between capital and labor is showing up in this instance for the smaller firms. Next slide. One place that you are familiar with that is doing very well is residential fixed investment, which is, of course, building houses. And you can see for the residential fixed investment, it's well above where it was for the 2015 to 20 time period. That's no surprise to you, as you've seen inventories at historic low levels of existing homes, and consequently much more of a burden on builders to help bring supply to the table. Non-residential fixed investment is basically back to where it was pre-COVID, but not beyond that at this point. Next slide. So what does all this stimulus mean for housing? Well, a couple of things. One is the monetary stimulus has been such that we saw certainly lifetime low interest rates in 2020, but the recent rise has gotten some commentary. But I would just fix for a historical reference the fact that if you were to take the year 2020 out of your calendar, and your calendar went December 31st, 2019 to January 1st, 2021, the interest rate on those 2 days would be essentially the same. It's just that 2020 was so incredibly low because of the impact of COVID on economic activity that it seems like interest rates have risen. Well, technically they have, but they're still today, absent 2020, at the lowest any of our lifetimes ever would have seen us since the advent of the 30-year fixed rate mortgage. So it's awfully difficult to complain about where interest rates are in the mortgage space today. The other thing that we wanted to show here was we took a look at what if a household had accumulated all of the stimulus that was sent that way. What would they have? This is, we were showing a couple with one child. They would have accumulated $11,400. And if they turned that into a 3% down payment, they would be purchasing a $380,000 home. So now, obviously not all of them did that. Some of them were already homeowners, some of them were renters, didn't intend to buy a house, but certainly at the margin, this has had an impact. And as you'll see when I show a chart on house prices, it's the entry-level house prices that have been appreciating the fastest. This is definitely a contributing factor. It's not the only factor. Part of the other factors is simply that the millennials have moved into home buying age and household structures. But certainly there has been an impact on the demand side in housing as well. Next slide. All of this has been debt financed. So that raises a question. Here's what I was showing, debt as a share of GDP today, back where it was while we were fighting World War II. So the question in the mind, the collective mind of the bond market is, what does this imply for the potential of inflation? Next slide, please. So what you saw and what has come to the headlines over the last week or so is a spike in the headline and core CPI. And whether you look at it year over year, and you have to be a little careful about that because April of last year was the depth of the pandemic, and essentially there was zero inflation in that time period. So an annualized month, I'm sorry, year over year number will look very large, and it was. So if you then take a look at the month over month change, turns out it still is. So this morning we released our updated forecast publicly with the headline that says economy expected to heat up through the summer as inflation risks mount, with a subhead of lack of listings and increasing supply constraints continue to limit existing and new home sales. So this spike in inflation, from our perspective, it's not going to remain at that size of a spike, but we will now, in our forecast, expect to see inflation run above the Fed's long-term average target. I'll talk a little bit more about that in a minute. Next slide. So when you look at inputs, the price of inputs, which is captured here, you can see that has risen. Those prices paid have risen to levels that in the last decade were only seen in 2018, as the Fed was tightening during 2018 and back in 2011. So another indicator that there is definitely some inflation in the system that will raise questions about how the Fed will respond. Next slide. So one of the things that has not driven the Fed to change policy yet at the moment is that the wages have remained fairly constant over the last 5 years or so. Although you've seen the headlines in the last few days about some companies that are intending to raise the hourly wage rates pretty substantially. So that will be something that the Fed will be keeping an eye on, and we've superimposed the core PCE inflation measure here so you can see just how much of a jump was in that most recent month relative to what wages are doing. Next slide. So here's the Fed. What this suggests, on the left-hand side, the infamous dot plot, and each of those dots is a Fed governor, and it's their guess on when will there be a move made and what will that move be in terms of the Fed funds midpoint of the target range for the federal funds rate. And you can see that it's past 2023 that the consensus exists that they will be above where they are today. Our view is that will happen sooner than after 2023. So the Fed is not only keeping interest rates at incredibly low rates, but they're also buying mortgage-backed securities at very substantial paces and building their balance sheet out. So both of those things are going to be policy tools that they will have to address as they attempt to coach the market on what they would like to see happen from a monetary policy perspective. Next slide. So this is the path of the Fed funds target. That's the lowest line, the 10-year Treasury, and then the 30-year fixed rate mortgage, which is priced as a spread above the 10-year Treasury. And you can see here what our actually, I think this chart didn't get updated today. You should see the 30-year fixed rate mortgage should be 3.4 at the end of 2021 and 3.7 at the end of 2022. Let me just double check that for a second. No, I stand corrected. That is our current forecast. So what it suggests is that we will see rates rise, but not precipitously. So that increase is is the inclusion of an increased inflation risk premium in interest rates. Still, hard to argue that a 3.5% mortgage is a bad position to be from an affordability perspective. So while the expectation is that the trend in rates will be to rise, unless we see a serious detaching of long-term inflation expectations in households, which leads to a strong response by the Fed, we still see this as a modestly increasing interest rate environment. Next slide. So this is a summary. I've given you most of these numbers. 7% growth this year, dropping off to about 2.8 next year, but that 2.8 is, if you believe the Congressional Budget Office's estimate of how fast the economy can grow, this suggests we will be growing faster in real terms than its estimated potential. And when that happens, we always get inflation. So what you see is the Fed has a target of an average of 2% inflation. We will exceed that from our perspective in 2021 and add another 50 basis points of inflation in 2022, which is why we think it's unlikely the Fed waits until after 2023 to start changing their monetary policy posture. Next slide. Excuse me. So, what we have seen is that the problem in the housing sector that's holding back total sales is inventory available to be sold. So existing home sales running at about 2 months supply, which is within a hair's breadth of the lowest since that data set has been created. So very low levels. There's a little debate about what would be a normal level, where normal is defined as equal bargaining power between buyers and sellers. Today, it's all on the seller side, which is why house prices are appreciating as they are. And the month supply, given the technology changes, might be something like 5 months might be normal. It used to be 6 to 6.5 months, but with all the online listings and all those things, our view is that the actual supply that would be equilibrating bargaining power is probably more like 4 months, something like that. You can see the big jump in new home sales because of the lack of availability of supply on the existing home front. I think let's go to the next. Let's go to the next slide. And one of the things that is going to be an inhibitor for the builders is going to be the cost of inputs. And so we saw permits and starts numbers that were under what was being estimated because we think these are starting to have an impact on the ability of builders to deliver on contracts that they have already signed, but where the houses have not been built. So as a personal example, I'm working on building a house, and in talking to my builder about 2 weeks ago, he pulled out his financials, and he said to help people understand what's going on, he has a standardized 2,000 square foot house, and in January of 2020, the cost of the lumber for that 2,000 square foot house was $5,000. In March of 2021, that same house, that same lumber, $17,000. So the fact that demand is as strong as it is, existing homes owners are not offering their homes up for sale, which is typically a first-time home buyer entry point. The builders are having to pick up the slack on that, and as you can see, that level of demand is raising input costs substantially. Part of it has to do, not the lumber part, but the other part of it has to do with global trade disruption that took place during the pandemic, but also was impacted by some of the trade negotiations and tariff changes. So the builders are up against it on the supply side to be able to deliver, and therefore you see the costs rising for input supplies. Next slide. So, and this is simply points out what I was saying, that in the most recent release, the single family home construction starts and permits fell off, in our view, partly because of this issue related to being able to get the materials to build. Next slide. So homes available for sale, you can see their total existing homes at historically low levels. Part of that had to do with the COVID, which I'll explain in a minute when I talk about house price and when the COVID hit. You can see new homes for sale also trending down, simply because that includes all the ones that were sold but not yet built. But the builders are slowing the pace at which they're signing contracts because they simply can't deliver because they don't have the materials. Next slide. All this, of course, impacting house price. And in 2020, house price rose over 10%. We think in 2021, it won't be far from that. So back in April of 2020, when the pandemic, which hit in March, really reached its maximum impact, we were asked the question, how far do you think house price will decline? And as some of you know, we do a monthly survey of 1,000 households, asking them a bunch of housing specific questions. And we observed in that time period, when we divided between existing homeowners and those who would appear to be renters who could become first-time home buyers, the attitude among existing homeowners was much more pessimistic than the attitude of potential first-time home buyers. Why was that? Well, the average age of an existing homeowner is older than a first-time home buyer, and the disease had been shown to have higher morbidity or mortality among older households. So you may not want to list your house for sale and have somebody come through it looking at it and bringing COVID, or you may have just believed that because of the disease, people wouldn't be out shopping because of the concerns about the disease. On the other hand, if you're a potential first-time home buyer, you could see historically low interest rates that you may never see again in your lifetime, and probably won't. So, and if you were a salaried worker whose job was proven to be stable during the COVID, it looked like a perfect time to buy a house. So again, what we went back and told the leadership of the company, we think instead of house prices falling, they're actually going to rise. The number of sales will fall, at least initially, but the price will actually rise because supply will fall further than demand. And that's exactly what happened. And I know lots of you have heard me give the 3 rules of forecasting. If you give a number, don't give a date. If you give a date, don't give a number. And if you get it right, don't look surprised. So we got that one right. The other thing that happened was, because the COVID hit in April, which is peak home buying part of the year in the housing cycle, the annual housing cycle, it distorted all the seasonal aspects of the data. So you have to be very careful in interpreting the housing data during this time period because of that distortion of the typical cyclical behavior. Next slide. So house prices have risen across most of the country, not everywhere. You can look on the left coast here in California, and you see San Francisco only up about 2%. Well, that's in part because it's a very densely populated city, and people were moving to get away from the virus and get out of that dense population into less densely populated jurisdictions. Next slide. So what has this change in house price done across the country? So I've given you 3 of the big markets in Florida to compare to the United States. What this is house prices today expect 2 incomes in a family. So if you look at the ratio of median sales price to median two-income family income, and this one is all families, so I'll come back to exactly what's shown here. You'll see that it's a little bit above normal, but it's pretty close to normal. This is a function of the rise of participation in the workforce by women. House prices adjusted to the fact that there were now two incomes available to buy the house. So the affordability problem now tends to be a one-income household's problem. They may have a good income, but it's not enough to afford a house. So here's what's happening in Florida. You see in Miami, the median sales price to median family income is well above the national average, and it has been rising quite strongly over the last year after a fairly long, fairly modest period of increase. During that time period, that ratio was staying pretty constant across the US, but has also taken a tick up in the COVID time period. Same thing, Tampa is still more available than the US average, and Orlando right at the US average. So you can get a feel for where the distortions are. And as you see at the top of the list, San Jose, San Francisco, Los Angeles, and San Diego. If you look at existing home listings, you will see that in those 4 California markets, the growth of listings has been much faster than the growth of listings across the rest of the country. There's 2 things at work there. One is the density of population and the desire to move away from population density. The second one is threatened tax increases, which would raise top personal marginal tax to something like 16% at the state level. So we in Florida, if you are active in financing home purchases in Florida, you probably have some Californians and possibly some New Yorkers that are in your pool of clients. Next slide. So this simply shows the darkest line on top. That's the pace of price appreciation in the lowest third of house price homes. The green one in the middle is the middle third of house price homes, and the brownish one on the bottom is the upper priced third of house prices. So you can see the house price appreciation is really being driven by the millennials, who have since 2015, 14 or 15, they've been the driver of the demand curve. And it's at the entry level, and all that pressure at the entry level has meant that those prices have risen fastest in the different categories of homes. Next slide. This is showing just for 2 cities, New York City and San Francisco. We can track the location that the household currently resides and the address for which they're making an application. And when that line goes up, it's an indication that there's a rise in the share of people who are moving from densely populated areas to less densely populated areas. So you can see there's been some slowing. There was an initial significant rise in avoidance of density. It slowed somewhat, but it's not all the way back to where it was. This raises lots of interesting questions. And it has to do with where we will work in the future. So for example, if you take that comment that I made about houses expecting 2 incomes, let's suppose that both of you commuted. You're a married couple with a child, so you really only need a 2-bedroom house, but all these boomers have suburban houses with 4 bedrooms. Are those houses going to see a price decline? Well, if you're going to be, each of you are going to be working from home 2 or 3 days a week, you're going to need an office. So those bedrooms get converted to offices, and that supply gets absorbed. So that's one thing. A second thing is, if you only have to drive to work 2 days a week or 3 days a week instead of 5, you might be willing to locate further out where housing is less expensive, because you don't have to make that longer drive as often. So those are a couple of things that we will track to see how behavior changes over time. Next slide. This just shows whether it's first-time home buyers or it's repeat buyers. In both instances, there was last year a significant move away from density. On the first-time home buyers, that's still underway in 2021. That does not seem to be underway for repeat buyers in 2021. Next slide. This is a change in listings. I've commented on California. You've seen the change in listings well above what it was at the peak of the pandemic in April of last year, but it's still significantly below where it was in 2019. So the supply on the existing home side still at extremely low levels, and that will hold the level of total sales down. Next slide. So in Florida looks an awful lot like the national trend in terms of listings. So it doesn't appear that the work from home arrangements are sticking the way in Florida the way that they have in some of the rest of the country. Next slide. So purchase demand still very strong in spite of the price increase and the little bit of a return of interest rates to that very low 3% level. Still strong demand is seen through applications. It's just that there aren't very many houses to pick from. Next slide. So one of the things that's come up is this a price bubble? And so one of the things that we're looking at is, what are the risk metrics? How much are people paying down? As you can see, the down payments have actually risen, whether by repeat buyers or first-time home buyers. You can also see that in terms of average FICOs, those average FICOs have risen and are at strong levels, nothing at all like where they were in the 2007 to 9 period. So the base story seems to be supply and demand and the fundamentals. And in fact, some people are complaining that credit conditions are too tight, but in a rapidly accelerating house price market, is that how you want to think about the risks that would be taken by loosening credit? I think we learned some lessons in the 2007 to 9 time period that we should make sure that we remember when we're working through this. Next slide. I'm going to jump past that one. Next slide. I'm going to leave some time for Q&A. This is a tracking of forbearances, and forbearances have more than half of them have been released. There's concern about a flood of foreclosures entering the market and changing the price path. Our view is there are four potential outcomes for any forbearance. One, the household sees the economic growth pick up and it restores their income, so they become current and the forbearance goes away. Second one is some of their income is restored, not to the level that they could meet the original mortgage obligation, but it gets restructured in a way that it keeps them in the house and they can meet it with the income that accrues as the economy is recovering. The third one is that almost all of these houses have some equity in them, in some cases a lot of equity in them. So if their income is not restored, they are likely to do a short sale or pre-foreclosure sale and walk away with some equity after having caught up on the mortgage payments that they owed. And this takes some time, so it's not as impactful on price because the negotiation can take over a longer time period. There will be some where there's not equity, where they don't have the income, and they will go through foreclosure. There will be some of those, but we don't see that being a large enough group to move house prices nationally. Next slide. Next slide. I'm going to go to the chart. Yeah, so I'll end here. So our expectation for 2021, about $4 trillion of mortgages. 2020 was $4.5 trillion of mortgages. So yes, $500 million less mortgages in a $4 trillion market. I'm not sure that there should be complaint. It will be the second biggest year in history if it occurs. So still a very strong market. Increase in the purchase component of the market, decrease in the refinance component of the market, but by any measure, a very strong year. And then some additional slowing, particularly on refinancing, if our estimate of the increase in inflation, which will drive up mortgage rates is anywhere close, you should see some drop off on refinances in 2022, but still a pretty good year by historical standards. So I'm going to end my comments there, and then we'll do some Q&A.
Okay, great. Thank you, Doug. Boy, that was a lot of great information. Love the charts and the graphs. Very much can understand that. So I appreciate that very much. We do have a few questions here. The first one is, and this is kind of a three-part question, so I'll ask all three, and if you need me to repeat it, I will. What is the outlook on wage inflation and CPI GDP growth? How will the market react in the next 24 months with wages? And do we see wages keeping up with CPI and GDP growth?
Well, that is one of the most important indicators in the Fed's mind is what happens with wage growth. And it's going to be really important to see what happens in September when some of the extended unemployment benefits expire and there's not a renewal of the one-time payments to households. So will they go back to work? If they go back to work, then that will actually hold down the pace of wage pressure. But you saw today in the news a firm that I think it might have been Citi that was saying that for their hourly wage workers, they're going to pay them $25 an hour to encourage them to come off of the public assistance and back into the workspace. That's upward pressure on price. If that were to happen broadly, then the Fed would interpret that as an inflationary impact, and it would raise the concern that the Fed would tighten sooner rather than later and put some upward pressure on price. In terms of GDP, those increases in wages, of course, are costs to businesses. And so whether that would impact the level of output or the price of that output, I think it would get bid into that, and that would also be seen potentially by the Fed as inflationary. So those are the things to watch over the next few months.
Okay, great. Thank you. There's a lot of in between the questions, everyone's saying great info, and thank you very much for very informative. So this is, I'm not sure this is a joke or not, but coming from the person I know who knows, it says, do you still use the sales of the Ford F-150 in economic forecasting?
Well, that's a great question. So they have a little historical knowledge. I drive a Ford F-150, just saying.
Good.
One of the indicators of the bubble in the 2007 to 9 time period leading up to that was a discussion that I had with then the chief economist at Ford Motor, Ellen Hughes Cromwick, because the housing market, the bubble in the housing market had led to a substantial increase in the sale of Ford F-150s, out of which small entrepreneurs operated their component of housing construction. So when we looked at what looked to start to be a turning point, which was 2007, we saw that employment was still growing, but for delinquencies started to rise, which had never happened before. We took that as a signal there was going to be trouble in the housing market. And so there's a video on the internet that gives credit to Ellen Hughes Cromwick for calling Ford's reduction in the production of Ford F-150s because it was going to go down with the downturn in the housing sector. So that was it. It's interesting somebody remembered that story.
Well, that's, yes, I'm glad to get that information. I did not know that, but you do see a lot of Ford F-150s in this area here. So they are all over the place. I know they are. Yep. Another question, as far as the commercial real estate, how do you feel that in the now and in the short term and long term that's going to be impacted with the
you really have to look at product type. So office space is going to operate quite differently than warehouse. Warehouse will do very well because of all the shipping that is done by Amazon and all of the buying online that has to have places for distribution and all that. So warehouse will do very well. Some industrial will do well if it's in the categories that are, you know, like auto, as they shift over to more electric vehicles and things like that. So some of the industrial will do well. Office, that's the $64 question. What's going to happen with the office space? Well, Fannie Mae has to think about that. We moved into some new facilities within a year before the crisis, before the COVID hit. And I'm in my office right at the moment for the second time in the last 14 months.
Wow.
So what happens? And walking around the blocks around here, over half of all the little restaurants that used to be here are gone.
Mm-hmm.
And the ones that did breakfast aren't opening until like 9 o'clock because they can't get the workers to come in to open and hold a longer offering. So that's a pretty important question, is how will companies decide to position their workforce? And our initial thought is it will be some sort of a hybrid, because they've figured out there are a bunch of things that can be done with people working remotely. Not everything, but a bunch of things. And so we think there'll be some sort of a hybrid that will emerge that will lead to some repricing of the office kinds of properties.
Okay, great. Okay, another question on the FHFA house price index slide. It looks as if home pricing is expected to decrease leading into 2022. Is that the prediction?
It is, and it tracks our expectation of the rise of inflation and therefore interest rates. So, and in addition, we expect that this shift away from the typical cyclical pattern will be restored going out into that 2023 time period. So the COVID-induced behavioral shifts will work their way through the system. So we'll see a slowdown in the pace of price appreciation out in that time frame.
Okay, great. Okay, another question here. As far as all the, I mean, we see a lot of it here in Florida, and I'm sure all over the country, but a lot of cash buyers. That's probably one of our biggest competitions out there from independent mortgage shops. So do you see that is ultimately will impact the mortgage industry with all the cash buyers, or do you feel that they'll be refinancing?
That's an interesting question. The data on that are not particularly good. The realtors have one set of data which comes from a separate survey they do from their multiple listing survey data, and they say it's not as statistically sound as their general releases. However, if you look at that over time, assuming it has the same weaknesses over time, the share that are cash is actually not much different. That if it had risen, it's actually now not much different from the long-term average. That is, of course, every house which is bought with cash is a house that doesn't have a mortgage, and so it certainly has an impact on those of us in the mortgage lending business. So it's worth watching, and it's probably more impactful in some jurisdictions than others.
Okay. All right. I think we have a final question here because we want to stay on time. Based on the given data, what is your opinion of potential housing price adjustment thanks to the end of foreclosure, eviction, moratorium, as well as the adverse impact from inflation? And how is your projection in mortgage rate in 1 to 2 years?
Well, I think that ties a little bit to the previous question, which is the slowdown in price. So to the extent that there are some homes that come onto the market through pre-foreclosure sales or foreclosures, that will help ease some of the supply side problem. And that rise in rates will also curtail demand to some degree. Those two things together will contribute to that slowdown.
All right. Well, there is a lot of, as I said, incredible information for all of us today. And for everyone on the call, we will be sending out the PowerPoint and the audio. I think one of the takeaways was a new acronym for me, the WFH, working from home. I hadn't heard that one. So we have a little tidbit here. But Doug Duncan, thank you so much. I know that you're a busy person with everything that's going on, and your support to the FAMP is very much appreciated and noticed, and we thank you for that, and everyone here. Thank you. It's a treat to have you here. It really is a treat, and it's an extreme honor. So everyone, thank you for being on the call today. If you are a member of FAMP, we thank you very much. If you're not, be a member and find a member. And we thank you all. So everyone have a great afternoon. Thank you again, Doug. Bye-bye.
Bye.